Welcome to my office hours. This is a review of Chapter 5 in ACC100. And in this presentation, I will reveal some highlights and insights about how to account for inventory. So based on a review of the textbook, the following is a list of the items that all of the students should understand to be able to respond adequately to the midterm exam and the Super Quiz 2, as well as the final exam. There are 7 items on this list, and the first item requires you to be able to manage transaction analysis and processing for the purchases of inventory by a buyer who is a merchandising company. A document has been prepared and is included with your textbook digital copy in Chapter 5 folder. We will review that quickly. Once we have completed this list of 7 items. But the one thing I will say about item number 1 is that when a buyer purchases inventory, this is basically a single transaction. Since it's a transaction, just a reminder, that's an exchange. And in the exchange, there are usually 2 parties involved. Well, there are 2 parties involved, each of which receives something and gives something in return. So when a merchandising company is buying inventory, they are receiving goods, which are classified as inventory on the balance sheet. The definition of inventory is goods held for resale. Since these goods can be sold and generate revenue, that is a future economic benefit, which is why inventory is classified as an asset. So inventory is the account, and it belongs to the financial statement elements assets. So the purchaser is receiving inventory, and what it gives in return is some consideration for the inventory. That consideration can either be payment in cash or a promise to pay in the future, the latter being accounts payable. The second type of transaction that you need to be able to analyze and process are sales by the vendor. Now, in this case, the vendor, of course, can be the same merchandising company that was previously a buyer of goods. It's just now it is selling those goods. And what distinguishes the transaction of inventory sales from inventory purchases is that sales involves 2 transactions, each of which has 2 parts. The first transaction is the sale of goods to customers recognized at selling prices. And the second transaction is the transfer of the cost amount of those particular goods from the inventory asset account to the cost of goods sold expense account. So it's a transfer of costs from the balance sheet to the income statement. Let me just back up a bit here. The second part of the transaction, sorry, I'm not sure if I said this already, is the transfer of costs from the inventory asset account to the cost of goods sold on the income statement. All right, the third type of transaction that we need to be able to analyze and process is what happens when a customer returns goods. And we should consider that we could have our own customers as a merchandising business return goods to us that we had previously sold to them. Or since we're purchasing inventory sometimes, we could also be the one returning the goods to our own supplier. So we need to be able to analyze and account for those transactions from both perspective of buyer and seller, because the merchandising company, depending on the transaction, can be either a buyer or a seller. So when goods are returned, the secret to accounting for this transaction is to basically undo what was previously recorded, either as a purchase or as a sale. So if we are a buyer, that relates to transaction type 1. If we're returning goods, we basically have to undo whatever the transaction was that we had previously processed for the first transaction type. And if we're not returning 100% of the goods, then we need to prorate the purchase and prorate the return for a portion of the original purchase. Now, if we are the seller of goods and our customer is returning those goods to us, then the same general principles apply, except that don't forget we are undoing a transaction of type 2, which means we actually have to undo two transactions, both the sale, where we generated revenue at selling prices, and the cost of the sale, which is at cost prices. And I'll wait to give you the details of that until I refer to the special document that was included with Chapter 5, which summarizes how to account for inventory transactions. Now, item number 4 deals with another transaction, which is not uncommon, although not as common as selling goods, and that is where we're buying goods and we're buying them on credit, or we're selling goods and we're selling them on credit. Then one of the things that we need to do as managers is negotiate. Scratch that. If we're buying and selling goods, this has nothing to do with buying them for cash or credit. It's just that we need to be able to possess the goods in order to be able to sell them. And so we may incur additional costs involved in getting the goods to our place of business, so that we can sell them to our customers, especially in merchandising businesses where people like to, touch the goods before they buy, which could be an automobile or it could be clothing. And so if you recall, in transaction 1, we were talking about what we've received were goods that go into inventory, which is an asset because they could be sold and generate future economic benefits. But this issue of shipping terms really is part of the question: how much do we recognize as being the cost of an asset? And one of the principles that I've expressed in class is that accountants determine the cost of an asset by including all costs that were necessary to get the asset ready for its intended use. And so the intended use of inventory is to resell it. Generally, that can only happen if we have the goods in our possession. And so to get them in our possession, we have to have them delivered from the supplier. Now, the shipping terms indicate who is responsible for the cost of shipment. And those are described in the FOB expression. FOB stands for free on board. If the goods that we purchase are free on board the point of origin, also called the shipping point, then it's our responsibility to get the goods from the supplier's place of business to our own. And the incremental costs incurred in getting the goods from the point of origin to our cost will be borne either by the seller, our supplier, or by us, the buyer, depending on the FOB expression. If it's FOB shipping point, we pay the cost of getting the goods from the shipping point or point of origin to our own place of business. If the term says FOB destination, then the seller or supplier has agreed to pay the cost of shipping from their place of business to our place of business. And of course, once they arrive at our place of business, we unpack them and stock them, and so they are basically ready and available for sale, but we didn't incur any cost to get them there. Now, if we are the seller, exactly the same rules apply. We could make arrangements to sell goods to a customer, which are FOB shipping point. And if that's the case, our obligation to perform ends as soon as we place the goods on a truck or we hand the goods to a customer in our store. No further action required, and we are not responsible for incurring any additional costs. But if our terms of sale include FOB destination, then that means we will pick up the cost of shipping the goods to our customer. There is a slight difference in how the cost of shipping is accounted for by a buyer and seller, and we will review that when we look at the corresponding document in Chapter 5. Now, in addition to getting the goods to our place, we also need to deal with the issue of, when is our customer going to pay us for the goods, or when are we going to pay our supplier for the goods that we purchase? And if we're buying and selling on credit, then the terms of payment will be specified on the invoice. And the common expressions, this is what I refer to as notation. The notation is something like 2/10, N30, which is read 210 net 30. And what that means is you must pay the invoice price in full by the 30th day. But if you pay by the 10th day, you are entitled to take, without further authorization, a discount of 2%. So that is an incentive that the seller of the goods offers the buyer of the goods to accelerate the payment, to make a prompt payment much sooner than the default period, which in my example was 30 days. And that reflects the value to each kind of business of collecting their accounts receivable quickly. So if we are purchasing goods as a buyer, as in transaction type 1, and we are offered credit terms of 210 net 30, then we would always try to take advantage of the 2% discount, and I'll try to tell you why in a moment. And if we pay the invoice by the 10th day, then we only need to pay 98% of the invoice amount. The other 2% is the discount that we took. And when we account for that 2% discount, if you think about it, the goods that we ordered at $100, if we pay within 10 days, they really only cost us $98. So the $2 that we took as a discount is accounted for by reducing our cost of inventory. And so the discount on a purchase reduces inventory. But if we are selling goods and our customer takes advantage of the discount, then one of the things that we like to do in accounting is track the discounts that are taken in a separate account. So rather than reducing sales revenue account, we like to keep that account pure and clean, and we'll set up a separate account called sales discounts taken, or discounts taken, to track the amount of discounts that customers are taking. Because not every customer will always take a discount. Some customers don't take it if they feel they don't have enough cash. And if we find out that all of our sales are on credit, we're offering 2%, 210 net 30 to select customers, maybe not every customer, then at the end of the year, we could see what our average discount rate on our sales is, and that'll help us in our planning and forecasting for future income and cash flow. Now, dealing with a merchandise company, one of the things that becomes different in our financial reporting is that rather than use a simple income statement, which reports revenues on the top line and then a list of all of our expenses, which are subtracted from the revenues to determine our net income, we like to create what's called a multi-step income statement. And so in a merchandising business, there are typically what I refer to as 3 steps or 3 blocks of information. I'll show you an example in a moment. But what you should remember is that each block has its distinct profit measurement. And so there are 3 popular profit measurements in a multi-step income statement for a merchandising business. And those are gross profit, operating profit, and net profit. Okay. And in calculating the gross profit, we also calculate gross profit as a percentage of sales revenue, net sales revenue. And that is called the gross profit ratio. And it is a very focused on metric for merchandising companies. In all classes that we had this week, I went through an example where we compared and evaluated the gross profit ratio for Walmart and Amazon. We also calculated the operating profit ratio for Walmart and Amazon. So calculating gross profit, of course, is a measure of profits, and calculating the gross profit ratio is a measure of what I refer to as profitability. And both of those terms, if you remember from earlier lessons, are used in assessing financial performance. It's part of assessing the business performance criteria of profits and profitability. All right, so that's what you're responsible for officially. In addition, I'm recommending that one of the things you learn to understand to give you a deeper insight into interpreting financial information is recognizing these three different levels of profit in a multi-step income statement, which are gross profit, operating profit, and net income, because each of them measures profit for a different reason. So in particular, gross profit measures the profit that a merchandising company generates simply as a result of selling goods, and it's a reflection of the pricing strategy they use in selling their goods, pricing to make a certain profit, as well as their purchasing effectiveness in buying goods at the lowest cost. So gross profit, if you're a single product company, like we're selling just blue jeans, and you're selling them, you're buying them for $30 a pair, selling them for $100, then you make a gross profit of $70 on each pair of jeans, and that gross profit of $70 divided by the sales of 100 is 70%. Okay, and that 70% is a reflection of the price of $100 and the cost of 30. So if you want to increase your gross profit ratio, there are only two variables that you have to contend with. One is your selling price and the other is your purchase cost. So that's what we use to measure profitability, because when we're planning and forecasting, the gross profit ratio is something we can apply to a sales volume or a sales revenue forecast. Now, operating profit is the income that results when we subtract all the operating expenses from gross profit. And so what you can appreciate is if gross profits are high, that high amount will trickle down through the income statement and end up increasing operating profit, right? Because the only difference between the two are the operating expenses that are in between. And I'll show you an example from the in-class demo question 5-2 in a moment. Whatever income lands on the operating profit line will also trickle down to the net income once we deduct certain other miscellaneous expenses, like finance expenses such as interest, sometimes depreciation if it's separated, and also income taxes, for example. So gross profit measures an enterprise's effectiveness in trading in goods based on their selling price and costs. Operating profit measures the enterprise's effectiveness at operating their chosen business model, because the operating expenses they incur are related to how they decide to do business. And net income, the significance of net income is it's the bottom line of the income statement, and it's what's left over for distribution to the owners of the business. All right. So that's the end of that. Let's now have a look at this document I was referring to. From chapter 5, which is entitled How to Account for Inventory Transactions. So there are 4 unique aspects that need to be accounted for, and we reviewed those briefly on the first slide of tonight's presentation. These are the original transaction of buying inventory or selling goods. Then we have these additional charges related to the delivery cost of moving the goods from seller to buyer. And then we have to deal with the possibility that goods may be returned. And finally, whether the discounts that are available under credit terms are actually taken or not. So this is a very helpful document. You can find it in the folder for chapter 5 in your textbook. And we've already discussed these, but let's focus on a couple. Here, for example, are the 2 transactions that we need to record if we're selling goods to a customer. We need to recognize the revenue. And if we are not being paid in cash, then we're setting up an account receivable for the customer to pay us in the future. Now, if you're a retail merchandiser, normally you're recognizing revenue and being paid in cash. But if you have a business-to-business organization, then typically you'll be selling your goods on credit, and you'll receive a promise to pay subject to the credit terms that you issue. So that is the part of the transaction which is at the selling price. Then we have to deal with the part of the transaction which is at cost. And the difference between these two, the revenue minus the cost of goods sold, in our example on the blue jeans, the revenue was $100 for repair. The cost of goods sold was $30. So only by including the cost of goods sold of $30 can we actually determine our profit in the income statement, which is what the purpose of the income statement is. That's why we need to be sure that we transfer the costs from the inventory to the cost of goods sold expense account whenever we are selling goods to our customers, okay? But when we're simply buying goods, we're receiving the goods, which increases our asset account inventory, and we're setting up a liability to pay for those goods if we bought them on credit. Now, the additional charges, if we are the buyer, so in the purchaser column, we will only have an additional cost to us if our supplier is selling us the goods FOB shipping point, because that means we need to incur the cost to get them from the supplier's place of business to our own. If we're buying goods and the terms are FOB destination, then there's no additional cost to us. But there's no additional cost to us because the supplier is picking up the cost of shipping. So if we are the vendor and we're selling goods to our customer, and we are supplying the goods under shipping terms FOB destination, then it's our obligation to get the goods to our customer, and we have to pay the cost of freight. And we account for that in what's called a freight out expense account. If goods are returned and we were the buyer, we're simply going to take them out of our inventory, send them back, and decrease the amount that we have to pay the supplier for. If we receive goods that are returned from our customer, then as I mentioned, we have to undo the sale. So if the sale had two parts like this, we basically have to receive the goods from our customer and put them back in inventory. So inventory increases, and we need to take the cost out of our income statement. So that's what this part of the transaction is. Take the cost out of the income statement, put the cost back in inventory for the goods that were received. At the same time, we need to reverse or undo the sales transaction at selling price. And so we're going to decrease our customer's obligation to pay us for the balance of any goods they've kept. So that's this decrease of accounts receivable. But rather than reduce sales revenue because we actually made a sale, somebody wanted to buy, and we want to track, the amount of business we're actually generating. Now, if the goods were received back and they're still in good condition and we can put them back in inventory, then we want to separate the return as a statistic apart from the original sale. So to do that, we use a special account called the Sales Returns and Allowances account, and that is placed into a contra account. So the accounts in an accounting system are organized and grouped by financial statement element, and the sales returns account will be among the accounts in the financial statement element called revenue, but it's separate from actual sales revenue because we want to track the extent of our returns. For example, if it turns out that we're getting 50% of our goods back, that statistic probably indicates there is a quality problem with the goods. If we're only getting 1 or 2% back, that could be just an indication that customers change their mind. All right, and then discounts relates to how much gets paid when the invoice is settled. So if we are the purchaser of goods and we originally ordered the goods at a certain price, let's say we bought 2 pairs of jeans for $60, and we have a liability to pay them for $60. And we're supposed to pay them within 30 days, but we can take a 2% discount if we pay them within 10, right? So if we pay them within 10, we can take 2% of our $60 cost, which is $1.20, and deduct that from the amount we have to pay, okay? So we'll end up paying, instead of paying $60, we'll pay $58.80. And since we're only paying $58.80, that actually reduced the cost of our inventory. So we're going to decrease the inventory by the $1.20. That's decreasing the cost of inventory, not the quantity, just the cost. So we'll decrease cash by $58.20. We'll decrease inventory by $58.80. Decrease inventory by $1.20. So there's decreases there of $60. And the offsetting decrease actually is in the accounts payable. We get full relief of our obligation to pay $60, even though we're not paying $60. And that brings the account payable down to zero. And a similar type of transaction happens if we're the seller. The only difference is that we track the sales discounts just like we track sales returns in a separate revenue account called sales discounts, okay? All right, now the only other thing I want to share with you is an example of the multi-step income statement that we created as a result of doing the in-class demo question 5.2. Now, I know many of you tried to work with me and keep up with the building of this Excel spreadsheet, and many of you may have missed getting it completed. So I thought if I include this in the video, then you'll have a record of it at least, and you can use it to try to complete the work that you were creating as you were working along with me. So what I wanted to show is the multi-step income statement in the merchandising company. So this represents the first block, and I just want to maybe shade this with a light color. Let's shade this with a light green. And this is what I will refer to as the first step, also called, let's say, the gross profit block. Each block ends with a measure of profitability. So when we take our revenues and subtract cost of goods sold, that will give us gross profit. But remember, I mentioned in some of those special transactions, we were actually tracking separately the sales discounts that were taken by customers and customers' returns of goods. So here you can see that we have separately accounted for all of the sales when goods were going out. We've separately identified those goods coming back, and we've also separately identified the amount of discounts that were taken. And if we add all of these up, they give us this net sales revenue. From that, we can subtract the cost of goods. So this is good. This is the goods that we actually sold and customers kept them and paid for them either at full price or a slightly discounted price. And the cost, this line represents the cost of those goods, because when some goods were returned, we took the corresponding cost out of cost of goods sold. And the gross profit is the difference between the net sales and the cost of goods sold. And the gross profit ratio is the ratio of gross profit dollars divided by net sales. If I double click on this, you can see the two cells that were used in the calculation, okay? In the second step of a multi-step income statement for a merchandising company, we have the operating expense block, or the operating income block, okay? And let's make this yellow for contrast. And we can also calculate the operating profit percentage. Now you can see that there are various categories of operating expenses. If we add them up, we have total operating expenses. And if we subtract total operating expenses from the immediately preceding profit measurement, we get the next profit measurement, which is operating income. So operating income equals gross profit minus all the operating expenses, okay? So if the gross profit gets larger, if we were to increase our net sales, let's say, by $1,000 with no additional costs attached, you can see that $1,000 trickles down to gross profit and all the way down to operating profit and to net profit. Okay. And then the final block that we have is what I call the miscellaneous expense block, or you can call it the net income block. And here we're deducting any other expenses, any other miscellaneous expenses like income taxes, finance costs, interest from our operating income. So just to recap, gross profit is the amount of profit the enterprise makes by trading in goods. Operating profit is the profit that remains after we subtract the operating expenses. The operating income measures the profitability of operating a particular type of business model. And the last level of profit is net income, which is after we deduct certain expenses which may or may not be controllable, like income taxes are not controllable at all, whereas most of the operating expenses are. And that's one of the reasons why they're grouped into this third step. But the significance of net income is that that is the amount that's available to the owners. And we can see that by the way it flows into the statement of retained earnings, right? It's the key addition to the statement of retained earnings. So that's the main difference in the income statement, the multi-step nature that applies to merchandising companies. And anyway, I hope that's been helpful and it will be useful to you in studying for your midterm exam.